G'day expats, ladies and gentlemen. Welcome to another episode of Expat Chat, episode 169 today. And I have a new guest, a new host with me today. We've got him on before and I've managed to lure him onto the episode once more. Mr. Martin Jack, one of our specialist financial planners here in the APAC office. Good morning, mate. How are you?
Morning, James. Yep, doing well. 169. That's getting that number right up there, isn't it?
I know, I love it. We're not really doing seasons. We're just doing every year. We just keep adding obviously more numbers and it's great, mate. Like the amount of hours that Brett and I have waffled on and somehow people have showed up and listened to us. It's really, really good. But mate, today I want to talk to you about an area which I know you're actually a real specialist in, to be honest, based on your client base, and the exposure that you have to the United States. We want to talk about, I guess, taxation of these US retirement accounts. But before we jump into that, let's just get a quick disclaimer out of the way, get obviously the compliance officers all happy around the world. Guys, anything you hear today should only be consumed for information or entertainment purposes only. It shouldn't be consumed as personal financial advice, tax advice, or anything like that. If you do need advice, please reach out to a qualified and registered professional, whether it's a lawyer, an accountant, a financial planner, and the list goes on. But mate, let's talk about it. I feel like this is topical at the moment because it's US tax time, but have you
Mm.
noticed any key themes recently with a lot of Australians that you've been speaking to that are in the US?
Yeah, plenty. I mean, that's it's an interesting space over in the US, that's for sure.
Yeah.
From the financial markets, the currency, but I think maybe even we mentioned this on one of the last podcasts that I did with you was just that increasing theme of people coming back to
Mm.
Australia. So obviously we talked a little bit about the green card and the exit tax and the consequences that come with that. But for the people who aren't long-term residents, one of the most common conversations that we've been having lately and continue to have, I should say, is around US retirement accounts. It's a very topical piece there to talk about, definitely.
Yeah, absolutely. I think it can be a bit of a minefield trying to unpack and understand like taxation because you've got the IRS when you're withdrawing them and then you've got the ATO and they treat the accounts very, very differently. So I thought what a great opportunity to get you on as a specialist and sort of, I guess, probably outline what are some of the common accounts first and then jump into the tax side.
Yeah, common accounts. Well, I mean, usually there's either the tax deferred options or those the ones that can be funded with after tax. But the most common three different types of accounts are your 401ks, which are your employer sponsored retirement accounts. I mean, you could do a sort of a self-funded 401k as well. It's a very, very unique. I don't think I've only come across that once actually.
Mm, mm,
Um, Traditional IRAs, they're usually for people who have consolidated retirement accounts from 401ks or multiple 401ks to have a little bit more control or ownership over that, or if they just wanted to start their own IRA. Obviously, the trade-off with that is typically less contributions can go in.
hmm
And then the last one that a lot of Aussies pick up and US citizens and tax residents are Roth IRAs as well. So they're those ones that are funded with after-tax contributions. But they're all slightly different, mainly a 401k, traditional IRA as well. The tax deferred vehicles. So they go in pre-tax, they grow pre-tax, then you pay tax upon distributions versus you have a Roth account, which is a bit different. You go in with after-tax money, they then grow tax-free, and then you draw them out tax-free as well, which is good as long as you sort
mm.
of have held it for more than 5 years. You avoid the penalty tax over the investment earnings. But yeah, I mean, they're the sort of key ones there. There's a few other ones like the state ones, the government pension
Mm.
ones, 403Bs, 457s as an example. They float around from time to time for sure, but the primary ones are those three, 401ks, traditional IRAs, Roth IRAs.
Yeah. And I think with a lot of our clients, when they're first going over to the US and I guess they're offered a 401k as part of their employment package, a really common question we get is, oh, do I opt into this? Do I contribute to it? And I mean, I know personally, like a lot of my clients, if they've got a matching scheme with the employer, like that's free money. Like if they don't do it, they're not going to get the match. So it's like, why wouldn't you want the free money? If But there are a lot of, I think, employers also which don't offer any match, which is a little bit disappointing because then you're just putting in your own,
Mm.
obviously, pre-tax money. It's helping you through the tax system a little bit. You're still putting something away. And sometimes that is probably still worthwhile if you're not doing anything else in terms of like super guarantee contributions. That's not happening. You're not saving anything in like another retirement account, like an IRA or something like that. But what are your thoughts on that? Is that something that you see regularly, recommending matching or going into a 401k if there is a matching?
Yeah, I mean, as you said, it's free money. You say no, you're not going to get it. And even the money that you are matching up to, it goes in pre-tax. So if
Hmm.
you think about a future withdrawal, you're probably going to pay 10 to 12% if you keep it on those lower bands. But your income earning potential right now is probably, much higher than those lower bands, which is about 50 grand over in the US at the moment. So if you're on 300 grand, $400,000, you're in much higher tax rates than even what those extra contributions that you're making would be when you actually made
Hmm.
those distributions. Probably even if you copped the early penalty tax as well. So,
Yeah.
it still usually makes sense to even opt in for these tax deferred retirement accounts. There's obviously big complications, or maybe not complications, but decisions that need to be made when you come back to Australia. If you're not a US citizen, of course. But yeah, free money, max it out as much as you can.
Hmm.
Get the tax savings is usually the go-to advice there.
Yeah, absolutely. Now, let's unpack taxation of these accounts. We've talked about what they are, matching schemes, employer sponsored, all those sort of things. Let's start from the US side. So, you ran us through like the typical type of accounts, tax deferred, after tax. Now, let's say we're starting to draw down an income stream from a 401k and we're, 62. How is it taxed in the
Mhm.
United States?
Yeah, well, 62, if it's 401k, you're over the age of 59 and a half, which means that you avoid the 10% penalty tax for early withdrawals. There is a sort of an exemption that can apply for the rule of 55, but
Mm.
in this case, age 62. So that means that the funds are coming out. Think of it like this. The IRS has said, we haven't taxed any of that money yet. So it's all going in pre-tax. It's going to be taxed and it's going to grow and grow and grow pre-tax, but we still want to get paid for that money that you've made. So when you
Mm.
make a distribution, ideally when you've retired, you're probably on a lower tax rate than what you are right now. That's when we're going to tax you. So essentially, it's that tax deferred vehicle. You withdrew $100,000 from your 401k. You're paying taxes on $100,000, or at least you're declaring $100,000 in income taxes.
Yeah, okay, that makes sense. And what about, you talked about these Roth ones. So how are they taxed then when we start pulling an income stream from?
Yeah, so they do incentivize people to add to their retirement account. I mean, that's the whole basis behind it, but they're typically made with after-tax contributions, which means that the IRS has already got their money. Uncle
Mm.
Sam's taken his money. You've got after-tax cash savings now. Now you can add it into this account within limits. There's contribution limits. Don't ask me that off the top of my head. But there are contribution limits naturally. And when you pull those funds out in retirement, well, they're completely tax-free. So they're very,
Mm.
very lucrative for growing wealth.
Mhm.
Now, if you're younger than the age of 59 and a half, then there are early penalty withdrawal fees. There's some extra rules around that, around if you have held it for more than 5 years, then you can take out contributions plus the investment earnings without that penalty applying. But if you
Mhm.
want it to be completely tax-free, yeah, you need to let it grow, reach over the age of 59 and a half, take those funds out, or at least the earnings component will be completely tax-free, as well as obviously your previously made after-tax contributions too.
Yeah. Okay. I mean, you've given us a really good understanding there actually of how it's taxed. Let's fast forward and let's say that US taxpayer, they've moved back home to Australia. Let's say they've just moved, they haven't like started taking, I suppose, any distributions or anything like that. How does the ATO see these kind of accounts?
Good question. Probably one of the most common questions I have on whether it's a new discovery consultation I'm having with clients, expats, or just existing clients returning.
Mm.
Look, it's a little bit interesting.
Mm.
Usually, all of these different type of retirement accounts they get seen under the one umbrella of a Section 99B, which is a foreign investment trust. Now, the way that the ATO breaks those accounts down, they basically break them into two key distinctions. And they'll see a component of it as corpus, which is
Mm.
effectively just your capital. So if you think about a 401k or an IRA, it's your employer contributions, your contributions and your employer matching contributions would make up that capital or that corpus component. If it's an after-tax account, so it's a Roth account, then it's your own contributions that have gone into that. Now
Yep.
that makes up the corpus. Then there's the other element, which is the investment earnings component. Now, under that Section 99B treatment, when you make a distribution in the ATO, you have to declare that entire distribution as income. But what degree of that income is taxable will depend on how much is corpus and how much is investment earnings, because it's an investment trust in their eyes.
Mm.
So if you've made money inside of that trust, well, we're going to tax you on those earnings when they come out. And that's what the ATO says at least. So let's use an example. You have $100,000 inside of a IRA account. Out of that, you've contributed $70,000 and it's grown by $30,000. If you were to make a full withdrawal, ignoring the US tax considerations for now, but from an ATO's perspective, they would look to tax that 30 grand, the investment earnings component. So
Yep.
out of a $100,000 withdrawal, 30% is obviously taxable in that scenario at your marginal tax rates here in Australia. Or if
Yep.
you're already earning taxes, already earning income here in Australia, it's obviously added on top of your income, tax at whatever that marginal tax rate is then.
Yeah, okay. And I guess it is a bit of a shame that the ATO lumps them all under the same umbrella, isn't it? Because like
Mm.
it probably, and this probably is where planning and strategy comes into it. Like if we consider the Roths, I mean, they should be tax-free in the US and definitely not tax-free here in Australia. So what should maybe a returning expat consider with their Roth accounts?
Yeah, well, I mean, if they've held it long enough to pull out the earnings without paying any penalty taxes and the contributions they can pull out, honestly, they could consider maybe withdrawing it all before they step foot back here in Australia, because it's not going to be captured by the ATO if you're still a non-tax resident. If the taxes on the US side are minimal to none because certain requirements, then it could actually make sense to withdraw that in full, just bring a lump sum of cash back to Australia and then reposition it for your life back in Australia, whether that's making some very aggressive super contributions, paying down debt, buying a future home, repurposing that, because maybe it served its purpose in the US, but you're no longer in the US. So let it serve a new purpose here in Australia, and avoid having to deal with the ATO's treatment of that Roth account, especially if the US consequences are minimal to none compared to what the ATO would actually do.
Yeah, absolutely. Yeah, I like the way you frame that as well, because they could pull it out and, as you said, repurpose it depending on what life dictates and what the goals are. If they're retiring, whack it into super, be mind of, I guess if they're a US citizen, green card holder, be mindful of the IRS on that kind of transaction. But there's definitely other ways that they could keep investing it towards their overall retirement income. Is there is there any accounts which are also uncommon, maybe when you're in the US? I know we've run through the other ones, but you said a 457. I feel like a lot of our listeners might not have heard of a
Mm,
457.
mm.
What is that?
Yeah, these are usually sort of typically like charitable type of accounts. So you could treat them like that. The contributions are usually a lot less when they go into these accounts. The
Yep.
benefit to these accounts, though, are you can draw them out under the age of 59 and a half or release them early without the penalty, at least.
Yep.
So that 10% penalty. Now, even the 403Bs and the 457s, there's special legislation here in Australia in terms of how we treat them. And it might not fall under the typical Section 99B treatment, but actually under the income tax treaty with Article 19. And, if it's a government-funded type of retirement account or a state-based account, then it can actually be completely tax-free here in Australia.
Mm.
So that can be a very lucrative plan to have those type of accounts, or if you've ever given the option or considering job opportunities over in the US where you are given accounts that from an ATO's perspective are under Article 19 of the tax treaty, then they're tax-free. So, you get the best of both worlds in that case. As an example, my client has a CalPERS pension. She works for the state of California, and that's coming out completely tax-free here in Australia. So quite a lucrative opportunity there for her
Mm.
to obviously grow all that and then come back to Australia and not have to worry about that taxation of that account.
Yeah, absolutely. That's huge. And like, I guess probably the last pension, which is probably the most common for a lot of our clients that have spent at least 10 years of that Social Security. Like, and It adds as a nice income supplement. I think I'm always having conversations with clients in the US whether Social Security is going to be around forever. Um, and do we bring it into their long-term retirement modeling and run a couple of scenarios, or do we
Mm,
leave it out and just treat it as an extra gimme, an extra little benefit? Because there's always conversations around whether it's going to be unfunded in the future. And
mm,
as you can see, it's pretty complex trying to understand like all the different retirement accounts and then tax and then when to
mm.
withdraw. Because it sounds like obviously there's different time frames in which it's going to be the most advantageous from a tax point of view to withdraw. Do you think there's sometimes where it might make sense to withdraw a 401k before coming back to Australia, depending on their circumstances?
Yeah, I think so. If it's a small account and
Mm,
you're a young investor, I mean,
yep.
what are you saving for by holding on to it? Let's run through a scenario of a small account. You got a 401k. You worked in the US for say 3 years. It's worth 50 grand USD. If you were to come back to Australia, you pay minimal taxes, probably on that 50,000 earnings component. But if you were to withdraw those funds in the US side, imagine the taxes you pay. You pay a 12% tax on a distribution of 40 or 50 grand, plus a 10% penalty fee on top of that as well. So you're paying about
Mm,
22% tax on that distribution. If it's a 401k, you probably had that matching scheme. So you might have already been in the 22% tax rate anyway. So it's kind of like getting your money back plus that free money. Sure, you wear an extra 10% tax now, but you get that funds available to you to repurpose somewhere else once again. So you could bring it to Australia as cash. You're earning Australian employment income. Maybe you make a big fat tax deductible contribution in Australia, save 32% here in Australia if you're on the top marginal tax rate, and then you paid 22% there, save 32% here, you come out on top and
mm,
you're done with the US. You close down that account. You don't have to worry about it, managing it until you're age 60 if you're a young investor.
mm.
Larger accounts though, yeah, it's a bit different. That 10% hit, it can be pretty heavy. So, maybe
Yeah.
it's best to position it a little bit better for longer term retirement planning.
Yeah, absolutely. And I think that's a good place in the today's episode to pause there because I feel like we could just keep talking about this. I think I might get you on actually on another episode soon because I want to unpack the recent announcement that's been drip fed out to the media about CGT discount concessions on property transactions and what it might mean for investors for the long term if Labor gets through and changes it from 25% or they remove it on property, what it might mean. But mate, that's
Mm,
been great. Obviously, this is a very complex area when it comes to trying to design a retirement plan, but you've got multiple overseas accounts, multiple taxes and jurisdictions, and it's good just to obviously bust a few myths there and obviously unpack it a little bit. For those listening in today's episode, keep an eye on the socials. We've got some upcoming in-person events in San Francisco and New York. Register if you're in town and come and have a chat, come and have a beer, come and chew the fat. In the meantime, mate, thanks for jumping on today and hopefully we'll see you on another episode very soon.
no worries, James. Good to be on.